Another theme for the year is that diversification became a lot more important. So what you're looking at on the left-hand side of your picture is it's a lot to digest, but it's basically different asset classes sorted by their performance. So, for example, in 2023 and 24, we had strong years. In those 2 years, large cap stocks were the main drivers of that. So they were the best performing asset class. And then as you go down this list, they're basically sorted by performance, right? If you look at 2025, large cap dropped into the third spot. What you see is international diversification. This is EM stands for emerging markets, so these are developing markets, and DM stands for developed markets. So these are both international sleeves. One is emerging markets, one is developed markets, and this becomes a place where you see, yes, large cap, the 17.9 we just talked about in the previous slide in the S&P 500, but look at these returns on the international side that are really helped to prop up or increase the performance of your portfolios. Even domestically, right? So on the right-hand side, I have domestically style boxes. So this is a large value, large growth, for example. So this box on the to the left of this year, this box shows a 10-year averages. This is the box for 2025. As you can see, very good performance across, and basically almost every category we beat those 10-year annualized returns. Now, what's the worry? The worry is the picture at the bottom here. The picture here at the bottom looks at the valuation, so P/E ratios, specifically forward P/E ratios, meaning expected P/E ratio based on expected earnings that are coming up, versus their 20-year averages. So, for example, large value shows 122%. That just means that the P/E ratio in that category is about 22% above its 20-year average. So in other words, prices have gone up so much compared to the earnings that it's generating. We are sitting pretty rich. Like if you look at every single category here, maybe except small value, you'd say that this is fairly valued, or small blend is pretty fairly valued. But large value, large growth, small growth is still is looking pretty rich. And that's some of the concerns that we have going forward, because that's not going to be we know there's at some point there's going to be a reversion to the mean, and we need to be prepared for that. Now, some of that roundup that I just talked about is about AI trade and the enthusiasm around AI trade, how much efficiency it's going to bring to the economy. Max 7, we've talked about that quite a bit throughout the year. Max 7 still played about 46% of the returns for the 2025 were driven by Max 7 stocks. On the right-hand side, I'll look at the hyperscalers, the cash flows that they are generating and are expected to generate versus the capital expenditures, which is the green line, or how much money they're investing in data centers and in infrastructure to be able to make those hopes of eventual earnings come through, right? So the difference is you can look at what we call a free cash flow. In other words, what do we take home after we make all that investments? These hyperscalers are making investments. And the cash flows are not looking great, at least in the midterm, because the investments in this area is so large and they keep growing.